Good evening from New York. It's 5:50 p.m. on Thursday, April 2nd, 2026. Welcome to the Lynx Data Insight Market Briefing. This analysis is AI generated by Lynx Data Insight and is for informational purposes only. It does not constitute financial advice. Markets are closed for the evening, and what a session it was. We had oil surging on Trump's Iran war speech, Tesla cratering on deliveries, pharma tariffs, private credit stress. Give us the full picture.
Let's start with the tape, because the headline numbers mask extraordinary crosscurrents underneath. The S&P 500 closed at 6581.56, up a mere 0.09%. The Nasdaq finished at 21,874.19, up 0.15%. The Dow actually closed red at 46,504.51, down 0.13. The Russell 2000 was the standout, up 0.72% at 2,530.37. The VIX at 23.9 tells you volatility is elevated but not panicking. The 10-year yield sits at 4.31%, the 2-year at 3.61, giving us a normal yield curve spread of 70 basis points. And the advanced decline ratio was 412 advancing versus 103 declining, so breadth was actually strong despite the flat index prints. The regime right now is what I'd call a supply shock purgatory. Equities are range-bound because the oil shock is severe enough to cap upside through inflation fears, but not severe enough yet to break the labor market and force a capitulation. Today was dominated by three forces: Trump's Wednesday night Iran war speech sending WTI crude surging 11% to $111.54 a barrel, according to CNBC. Tesla's disappointing Q1 deliveries, and deepening stress in private credit via Blue Owl's redemption gates.
Let's drill into that oil move, because an 11% single-day surge in crude is not something you see outside of genuine crises. What exactly changed after the speech?
The market had been hoping Trump's address would offer a clear exit strategy. Instead, he doubled down, saying the U.S. would hit Iran extremely hard over the next 2 to 3 weeks, with no plan to reopen the Strait of Hormuz. According to CNBC, WTI May futures settled at $111.54, up $11.44 on the day. Brent June futures settled at $109.03, up $7.87. But here's the number that should genuinely alarm investors. S&P Global reported that dated Brent, the spot price for physical cargo delivery in 10 to 30 days, hit $141.36, the highest since the 2008 financial crisis. That's a $32 premium over the futures contract. Amrita Sen of Energy Aspects told CNBC the futures market is almost giving a false sense of security. European diesel is trading near $200 a barrel. TD Securities estimates nearly 1 billion barrels will be lost by month-end, comprising up to 600 million barrels of crude and 350 million barrels of refined products. Every additional month of conflict adds 450 million barrels of lost supply. The causal chain runs: Hormuz closure pushes physical crude to $141, diesel surges toward $200 in Europe. That feeds directly into transport and fertilizer costs, which, according to CNBC's reporting on the grocery inflation story, pushes food prices higher. Food inflation already sits at 3.1%. Gas Buddy's Patrick DeHaan estimates U.S. retail gas could hit $4.25 to $4.45 a gallon in the next 2 weeks, with diesel at $5.80 to $6.05. That's the consumer spending destruction mechanism that has Goldman, Moody's, and EY Parthenon all flagging 40% recession odds.
But equities barely moved. The S&P was up 9 basis points. How do you reconcile an 11% oil surge with a flat stock market?
Two things saved the session. First, Iranian state news agency IRNA reported midday that Iran and Oman are drafting a protocol to monitor transit through the Strait of Hormuz. The word facilitate was used. That snapped equities from deep red to green intraday. Second, the semiconductor and AI infrastructure complex exploded higher and offset the energy drag. 7 of the top 10 gainers were technology stocks. The Iran-Oman headline is the market clinging to a diplomatic off-ramp, and the tech rally reflects a genuine secular story. DRAM prices surged 90 to 95% quarter over quarter, and memory suppliers are sold out through 2027. Micron reported record DRAM revenue of $10.8 billion in fiscal Q1 and guided Q2 revenue to $18.7 billion. So you had war-driven oil inflation pulling equities down and AI-driven semiconductor demand pulling them up, and the net effect was near zero on the index. That's the bifurcation defining this market.
What does all of this mean for the Fed? Because the 2-year at 361 is sitting right on the Fed funds proxy. The market seems to think rates are going nowhere.
That's exactly right. The 2-year at 3.61% versus a Fed funds proxy of 3.61% tells you the market sees the current rate as approximately terminal. The normal curve with a 70 basis point spread says cuts are still in the forward path, but nobody expects them imminently. The Fed is trapped in a classic stagflationary bind. On one side, you have headline inflation that will accelerate, diesel near record levels, gas above $4, food inflation already at 3.1% and rising. On the other, the labor market is freezing. The hiring rate fell to 3.1%, the lowest since the COVID recession. Tomorrow's March jobs report is expected to show just 59,000 non-farm payrolls, with unemployment at 4.4%, though the market will be closed for Good Friday when it drops. The critical distinction is this: the Fed typically looks through energy-driven headline inflation unless it contaminates core prices and unanchors expectations. We're not there yet. It takes quarters, not weeks, for diesel costs to fully bleed into core services. So the most likely path is a prolonged hold through at least June, with dovish forward guidance contingent entirely on whether oil normalizes. If the Hormuz situation resolves within weeks, this is a transitory headline shock. If it persists through summer, the transmission into core becomes unavoidable, and the Fed faces an impossible choice between fighting inflation and cushioning a recession.
So, who are the clear winners and losers coming out of today?
On the winner's side, the cyclical standout is SBA Communications, up 19.11%, a tower REIT benefiting from infrastructure and connectivity demand. In the semiconductor complex, Ciena surged 11.67% on AI and data center optical networking demand. Intel jumped 9.38% on its Fab 34 reclamation news, a direct reshoring tailwind. SanDisk rallied 9.25%, and Corning gained 8.45%, both riding the DRAM and optical fiber infrastructure story. Micron added 7.26% on those record revenue numbers I mentioned. Among the Magnificent Seven, NVDA was the biggest mover, closing at $177.40, up 3.03% on the day. It's trading below both its 50-day moving average at 182.76 and its 200-day at 179.64, down 6.93% year-to-date, but with a one-year return of nearly 60%. This is a stock where the secular demand story, data center revenue up 75% year-over-year, is fighting against macro headwinds and multiple compression. Structurally, energy has the broadest strength of any sector: 70.09% of stocks above the 50-day, 86.32% above the 200-day, and 21.53% near their highs, with only 3.83% near lows. That's nearly half the sector making new highs while the market goes sideways.
Wait, 5 of the top 10 losers today were energy names. How do you square that with energy being the strongest sector?
Great catch, and this is an important distinction. The energy losers, EQT down 3.83%, APA down 3.76%, Expand Energy down 2.76%, Occidental down 2.54%, Phillips 66 down 2.46, these are predominantly natural gas producers and downstream refiners, not the integrated crude producers benefiting from the oil surge. EQT is the largest U.S. natural gas producer. Natural gas has a different supply-demand dynamic than crude. APA and Occidental have hedging programs that cap their upside in a spike, and the market penalizes that. Phillips 66 is a refiner where surging crude input costs compress crack spreads, so the sector scorecard showing broad energy strength is correct at the macro level, but within energy there's massive dispersion between crude-leveraged producers and everyone else. On the loser side, structurally, real estate is the weakest sector in the market, only 17.2% above the 50-day moving average and 21.46% of stocks near their lows, the highest distress reading of any major sector. Rising yields at 4.31 on the 10-year and inflation fears are crushing rate-sensitive assets. Consumer defensive, which should be a safe haven, has 19.81% of stocks near lows. That's a strikingly high distress reading for a supposedly defensive sector, driven by margin compression from surging input and transport costs. Technology has only 28.39% of stocks above the 50-day, with 15.47% near lows. Broad weakness despite pockets of AI-driven strength.
You mentioned Tesla and private credit as secondary catalysts. Tie those back to the main narrative for me.
Tesla reported approximately 356,000 Q1 deliveries, missing both the street account estimate of 370,000 and Tesla's own compiled consensus of 365,645. The stock dropped more than 5% intraday, its worst session of 2026, and closed at 365.55. It's now down about 20% year-to-date, trading well below both its 50-day at 404.90 and 200-day at 396.76. The energy storage miss was arguably more concerning, 8.8 gigawatt-hours deployed versus 14.2 in Q4 2025. William Blair analysts said they were confused as to what happened with supply. The connection to the macro picture is twofold. Tesla's demand weakness reflects the broader consumer cyclical stress. The sector has only 22.93% of stocks above the 50-day, and paradoxically, CNBC noted used EV sales have been rising since the Iran war began as consumers flee gasoline costs. Tesla's Q1 earnings on April 22nd will be the next inflection point. On private credit, Blue Owl's flagship OCIC fund received redemption requests of 21.9%, and its tech-focused OTIC fund received 40.7%, both gated at 5%. Blue Owl attributed this to heightened market concerns around AI-related disruption to software companies. Software represents about 20% of private credit portfolio exposure, according to Jefferies. This is a canary in the coal mine for liquidity stress in an $800 billion-plus asset class, and it connects directly to the AI story. The same AI wave driving NVIDIA's data center revenue is simultaneously threatening the loan portfolio backing private credit funds. Amazon imposing a 3.5% fuel and logistics surcharge on its 2 million third-party sellers effective April 17th is another real-world manifestation of the oil shock flowing into corporate cost structures.
What's the risk case investors should be stress testing right now, and how are you framing the base case?
Our base case, which we decide about 55% probability, is that the Iran-Oman monitoring protocol offers a credible enough diplomatic off-ramp to partially relieve supply panic over the next week or two. In that scenario, WTI trades in a range of $105 to $118, Brent futures $103 to $115. The S&P holds a range of 6,400 to 6,650. The 10-year yield stays between 4.20 and 4.45. The March jobs report drops tomorrow with the market closed, showing roughly 59,000 non-farm payrolls, weak but not catastrophic in a world where the St. Louis Fed estimates break-even payroll growth could be as low as 15,000. The Fed holds through June. Equities stay range-bound with elevated volatility. The risk case, and I'd put this at 30% probability, is materially more dangerous. If the Iran-Oman talks collapse and Iran escalates strikes on Iranian energy infrastructure, extending the strait closure through summer as he's threatened, onshore oil inventories could fall to multi-year lows by August, according to TD Securities. WTI could hit $125 to $140. Brent spot could exceed $150. Diesel at nearly $200 in Europe cascades into a global recession via food and transport inflation. The 10-year yield could spike to 4.60 on a term premium surge from inflation expectations. The S&P target in that scenario is 60.50, roughly an 8% drawdown from here. The transmission chain is prolonged strait closure, inventory depletion, diesel-driven input cost inflation, consumer spending contraction, corporate margin compression, particularly in consumer discretionary, industrials, and transport, and a formal recession call. The upside tail, which I'd assign 15% probability, requires an Iran ceasefire agreement within 1 to 2 weeks with verifiable strait reopening, combined with a strong March payroll surprise above 100,000. That could push WTI back toward $80 to $90, unwind the inflation and recession premium, and refocus the market on the AI capex cycle. The S&P could push towards 68.50 in that scenario.
So, in terms of positioning, what should investors actually be doing?
Highest conviction, maintain and selectively add to energy producers, not the natural gas names that sold off today, but crude-leveraged integrated producers. The sector breadth confirms this is a structural, not a tactical position. Secondary conviction, AI semiconductor infrastructure names like Micron, SanDisk, and the optical networking plays like Ciena and Corning. The demand signal is unambiguous. DRAM supply-demand is the tightest it's ever been, orders booked through 2027. Buy the pullbacks in names with contracted revenue visibility. Tactical hedge, if the VIX pulls back toward 20 on any ceasefire headline, that's a window to buy put protection on the S&P or the NASDAQ. This level of geopolitical uncertainty doesn't resolve cleanly. Structurally, maintain utilities exposure, nearly 45% of the sector near highs, classic late-cycle positioning that works in both the base case and risk case. Avoid list, real estate until yields definitively turn lower, consumer defensive names that lack pricing power, the sector's distress reading at nearly 20% near lows tells you the market is already punishing them for margin compression, and any private credit exposure with significant software lending books until the redemption cycle clears.
How does it all fit together?
When you step back, this is really about an economy caught between two powerful forces running in opposite directions, an energy supply shock that's destroying consumer purchasing power and threatening a recession, and an AI infrastructure build-out that's generating genuine, contracted, multi-year demand growth in a narrow slice of the economy. The market is essentially flat because those forces are canceling each other out at the index level, but underneath there's massive dispersion. Energy and utilities are making highs, real estate and consumer sectors are making lows, semiconductors are rallying on secular demand, while private credit funds are gating redemptions because of the same AI disruption creating that demand. Every thread connects back to the Strait of Hormuz. Its closure is the variable that determines whether this becomes a transitory headline shock or a genuine recession catalyst. The base case says diplomatic efforts and the Iran-Oman protocol prevent the worst outcome, but the alternative view deserves serious weight. If the strait reopens within 2 weeks and oil normalizes toward $80 to $90, the sell-off in consumer discretionary, real estate, and broad tech represents a significant buying opportunity. Those sectors are priced for a recession that may not materialize. Microsoft, down 21.72% year-to-date and trading at $373.50, well below its 200-day moving average of $475.78, would be among the sharpest snapbacks in a ceasefire scenario. Alphabet up nearly 90% over the past year, but down 5.57% year to date, similarly has room to reprice. The key is that every portfolio decision right now is really a bet on Hormuz.
Give us the 3 takeaways to close.
First, the risk. Dated Brent at $141.36, the highest since 2008, tells you the physical oil market is far more stressed than futures suggest. If the strait stays closed through summer, the recession probability moves from 40% to a near certainty. Position accordingly. Second, the market insight. Today's advanced decline ratio of 4-to-1 bullish despite flat indices reveals hidden rotation. Capital is flowing into semiconductors, energy, and defensive utilities, while draining from rate-sensitive